Okay, folks. Okay. Should I start with a question, or is it insulting at this point? I'm going to start with just one question. I'm going to assume that everyone is in a group, so I'm not going to ask that question. If you're not, and you're too ashamed to admit to it, just see me after class or tell me in private, or put it up somewhere so people can find you. But how many of you have not picked a company yet? Okay. You know what I'm going to say next, right? Pick a company, let's get moving, because we are now in the process of actually dealing with numbers. Okay? So I'm going to start this morning's session, obviously this afternoon session. I'm completely lost at what time of the day it is, with a question to see if the risk-free rate discussion we had last week stuck. We talked about risk-free rates. We talked about risk-free rates in different currencies. Let's say that you are looking at a Swiss multinational. If you hate abstractions, call it Nestle if you want, which gets revenues from all over the world. Let's assume that it gets 10% of its revenues in Switzerland, 30% of its revenues in the EU, 40% in the US, 20% in India. And let's suppose I gave you risk-free rates in each of those currencies, in the Indian rupee, the euro, the dollar, the Swiss franc. Okay? So everybody clear on the facts, right? So here's my question. When I'm valuing this company, what should I use as my risk-free rate? And I'll go through the choices, and if this is the choice you would like, you don't have to put up your hand, at least acknowledge it. A simple average of the four numbers. You're saying, oh, I'm an MBA, I don't never take simple averages. I mean, this is why we have to have something. How about a weighted average? That sounds more sophisticated, right? Come on, some of you are saying, that sounds like the right answer. I'll let it float for the moment. If you think that's the right answer, we'll come back to it. Maybe I should use the Swiss franc rate. After all, it's a Swiss company, and why not just stick with the local currency? The lowest of the rates, which might end up being the Swiss franc rate as well, but the lowest of the rates. The highest of the rates. Why? Because you want to be conservative. Maybe the answer is none of the above. Anybody want to try what the answer is on this one? What should I use as my risk-free rate? The one that, so none of the above is actually the right answer, because, or you could use any of these currencies. You can value Nestle in rupees, you can value it in Swiss francs, you can value it in US dollars. The answer is you pick the currency, you do the valuation of that currency. There is a way in which, if you want to stay with local currencies, you can do it. You know what you'd have to do? You'd have to value Nestle India in rupees and use a rupee risk-free rate. You could actually value each part of the world. The reason, and we'll come back and talk about why this is so difficult to do, it's not because we don't know how to do it, but the information is often not broken down at a regional level well enough for you to be able to do. So when you value a multinational, you have no choice. You're saying, why can't I use a weighted average of the risk-free rates? Why? Remember the analogy I gave yesterday, the last session, about Fahrenheit and Celsius, right? Basically, you take temperatures in Fahrenheit and temperatures in Celsius, you average them out, you get junk. You get weight in pounds and weight in kilograms, you add them up, you get junk. Currencies are measurement mechanisms. I can't mix and match, so you can never take simple averages. You can't. It's amazing how much confusion this concept still creates in valuations. How many times I see valuations where people have used weighted averages or average risk-free rates. You cannot do that. That is not a choice. Right? Let's keep moving. We talked about historical risk premiums last session. Remember, we looked at data and we came. And a lot of people still are stuck on historical risk premiums. So let's assume you decide to go down that route with all the perils that come with it, backward looking, noisy. So my question is an estimation question. When I want to estimate a historical risk premium, assuming that's what I want to do, should I just take the last year? After all, it is the most updated, the most current number I can. Let me pause right there. If I just took the last year and I computed the historical risk premium for the US for the last year, 2018, what would my risk premium look like? Was last year a good year for stocks or a bad year? It's actually a pretty bad year because the last quarter demolished stocks. Last year, returns on stocks was minus 4 point something percent. The return on T-bond was minus point. It's the first time since 1969 where both stocks and bonds had a negative year. But stocks we did far worse than bonds. So the risk premium for last year would have been minus 4 point something percent. Can you imagine doing a valuation where you say that's my risk premium for the future? That's going to be strange because you're saying the risk-free rate is 2%. I will accept minus 2% on stocks. So clearly last year doesn't make sense. How about the last 5 years? Because at least you're getting some averaging. What's going to be the problem? Remember the standard error number that we saw even with the 10-year average. With a 5-year number, that's going to be even greater. It's going to be incredibly noisy. In fact, you can see why you have to go back as far as you can because the number you're going to get is going to be an incredibly noisy number if you use shorter time periods. So part of you says, I want something updated, but historical risk premiums, that's not going to work. You're saying, what if I slice up the data finer, do monthly? It's not going to help you. It's still going to be noisy. And one final thing about historical risk premiums, which I did not get to mention last year. Let's assume that this year ends up being a terrible year for stocks. I'm not making any predictions. I'm just saying, let's assume. Let's assume stocks are down 30% this year, like they were in 2008. So the end of the year, let's assume I compute an update. Remember my premium went 1928 through 2018? Let's say I now add 2019, and 2019 happens to be a horrifically bad year, a crisis year. Mathematically or mechanically, what's going to happen to my risk premium? Is it going to go down or go up when I add the 2019 numbers? It's going to go down because if I take a terrible year and add it on, the minus 30% is... You see why that's counterintuitive? You're in the middle of a crisis. Do you feel less afraid or more afraid? I always feel more afraid in a crisis. And what's a historical risk premium saying? Hey, don't worry, your risk premium just went down 1.5%. Historical risk premiums are counterintuitive. In good times, when stocks are going up and you feel good, it says you should demand a higher premium. In bad times or in crisis, they say, hey, it's okay to settle for a 3% premium. One more reason to mistrust historical premiums. So I already said a lot of that last session, but I still haven't told you what I'm going to use instead. So today we're going to talk about that, but I'm going to set up a little experiment to kind of illustrate the process by which I'm going to come up with a forward-looking implied premium. And I need a guinea pig. Do you want to be my guinea pig? Don't worry, it's a very simple exercise. You just have to go with your gut. Okay. So here's my first question. Let's assume I came to you with an investment where I promised you $1 a year every year in perpetuity guaranteed. How much should you pay for that investment? Just give me a number. Doesn't have to be, there's no right number. So think about it now, $1 a year every year forever. $20, okay. If you pay $20 for an investment that pays $1 a year, what's your return going to be each year? So it's going to be $1 divided by 20, which would be 5% a year. Okay. As I said, there's no right answer, so file that away. So on a risk-free investment, you demand 5%. Let me change the facts a little bit. Let's assume it's still an investment that's going to pay $1, but now it's an expected dollar. There's risk around it. So now it's not guaranteed. Would you pay less or more for that investment? You pay 20 for a guaranteed $1 a year. Now I'm saying it's uncertain. Would you pay less? Okay. So give me a number. $10. Thank you for giving me nice round numbers. It makes it easier for math. Because if you pay $10 for the investment, your expected return on that risky investment is 10% a year, right? It's $1. You just gave me a risk premium. Do you see what the risk premium is? Clearly it's a very, it's still a little fuzzy because I didn't define how much risk. But you said because it's the riskier investment, I'm going to demand a 5% higher premium. I'm going to do exactly the same thing using all stocks. Do I know what people pay for stocks? It's the one thing I know, right? Because I know what you paid for stocks. I can look at the S&P 500 today. This isn't some abstraction of what I think. This is what people were willing to pay. So just as she said $10, people have said this is how much I'm willing to pay for stocks. Do I know what the expected cash flows will be in the future on stocks? I don't, but I could make an estimate, right? You're saying it's an estimate. Of course it's an estimate. It's risky. So I'm going to make an estimate of expected cash flows in the future. And if I can give you those expected cash flows and the level of the index, the math problem is a little messier because it's not a fixed number. But I could solve for an internal rate of return, right? A rate of return that makes the present value of the cash flows equal to the S&P 500 today. And that would be a measure of what people are demanding for investing in stocks. You're saying, I don't like that number. It's not for you or I to say, I like that number. This is what the market's saying it's willing to pay for stocks. I'm going to use that as my basis for computing an implied premium, implied by the index. And that number, will it change over the course of a day? Yes, as the price changes. Because if during the course of this day something bad happened to you and you got more risk averse, by the end of the day you might say, that dollar you offered me this afternoon, I'm now willing to pay only $8 for that. I was told it $10, but things have changed. Basically, implied premiums are going to be both forward-looking and dynamic, and that's exactly what we're looking for. So enough with the setup. Let's dive back into where we were when we left off on Wednesday. So we were talking about country risk. So let me go, because I know it's been a long time, you've probably forgotten. Now, I said we can get a risk premium. Let's say we can get a risk premium for the US. I said it's going to be impossible to even try to get a historical risk premium in most emerging markets, even in most developed markets. So I suggested two ways in which you could get a risk premium for an Indonesia, Vietnam, and India. The first and the simplest way, and I said this is the way most people do it now, is to take the default spread, the same default spread we took out of the government bond rate to get the risk-free rate, either based on the rating or the sovereign CDS or something based on the country, and take it and make that your estimate of the risk premium for the country. So in the case of Brazil, for instance, that default spread was 3.39%. I added to my US premium of 5.96%. to come up with a risk premium of 9.35% for Brazil. That was approach one. The limitation of that approach is I'm taking default risk, that is really what you would demand for buying a government bond, and making it the premium in the equity market. The second approach, which I said Goldman came up with, and I'm not sure Goldman still sticks with it, is look up two standard deviations. One for the US, one for Brazil. And based on those standard deviations, come up with a measure of how much more riskier so basically this was the approach we ended with, how much more risky the Brazilian market is relative to the US market. So if the standard deviation for the S&P 500 is 18% and the standard deviation for Brazil is 30%, the Brazilian market is about 1.67 times more risky, 30 over 18. And you multiply that by the US premium, you come up with a risk premium for Brazil. So basically in the second approach, you don't even look at the government bonds, you look at volatilities across markets to come up with the risk premium for the market. And I ended the session with a weakness in this approach, which is if you're in an emerging market with very little liquidity, Nigeria, Ghana, parts of Asia, Cambodia, Vietnam. Does Cambodia even have an equity market yet? But you take a market like that where there's very little liquidity, the standard deviation for that market is going to be low. And if I use this approach, I'm going to end up with this absurd result of this market has no trading, therefore I'm going to demand almost no risk premium. So I'm going to create a third approach which borrows from the first two. I like the fact that the default spread is an observable number, right? I can look it up in the market, I can see what it is. So I like that fact. I also like the fact that there is this observable measure of risk, which is volatility. So here's what I did. It's very close to the Goldman approach, but rather than compare across two markets which might be very different in terms of liquidity, I stay within the same market. So I'll stay within Brazil, assuming that if one market is illiquid in that country, the other market is also going to be illiquid. So at least I'm comparing apples to apples. Again, I look up two standard deviations, just like in the previous approach. But the standard deviations I look up here are the standard deviation for the Brazilian equity index, the 30% that I did before. But now instead of looking at the S&P 500 standard deviation, I'm going to look at the standard deviation in the Brazilian government bond. And that's 20%. You're saying, how is that going to help me? What is the default spread I charge for buying the Brazilian government bond? 3.39%. I'm now telling you stocks are 1.5 times more risky than bonds, right? 30 over 20. 1.5 times 3.39% gives me 5.09%. That is my additional risk premium then for Brazil, which added on to my US risk premium is going to give me a total risk premium of 11.05%. So let me review. The first approach, pure default spread. Second approach, relative equity market volatilities, but the problem there is different liquidities. Third approach, I'm starting with the default spread, but I'm saying equities are riskier, so my risk premium for equity should be higher than my risk premium for bonds. And this is good. So to use this approach then for a country, I need to observe standard deviations in the stock market, which is relatively easy. You can find that in Bloomberg. And standard deviations in the government bond, which requires two things. First, that there be a government bond in that country, which is not available for 130 countries. And second, that that bond be traded. Many government bonds are issued, they're not traded. So every year I wrestle with this, because at the start of every year, I go through this process of trying to estimate equity risk premiums for countries. So at the start of 2009, I ran into the same issue. I could look at the default spreads. That was easy. But looking up the standard deviation of the government bonds is messy. So here's the approximation I used at the start of 2019. And I've done this every year for the last 20, so you can see it in 2018, 2017. First step in the process is I compute an equity risk premium for the US. And I'll take you through the process of how I came up with the 5.96%. It's not a historical premium. It's an implied premium as of that day, 5.96%. I start with that as my base. Then I look up the sovereign rating for every country that Moody's has a rating for. It's about 160 countries. I look up those ratings. If Moody's does not have a rating, I check to see if S&P has a rating. So by the time I'm done, I have about 150 countries for which I have a sovereign rating. Third step, I take that sovereign rating and convert to a default spread by looking at what that rating is. So I have a default spread of every country. I can see the finish line, right? Last step, what do I need to convert that default spread into an additional premium? I need to look up the standard deviation of the government bond and the standard deviation of the equity index in each country. And as I said, that's where I got stuck. So here's my approximation. People might view it as too much of a bludgeon, but I need to keep moving, because if I get stuck, I'm never going to get done. So I looked up two standard deviations. But instead of looking up for each country, I looked it up for an index. The first index was an S&P Emerging Market Equity Index. I looked at the standard deviation index. I got a standard deviation for equities in emerging markets. The second index is an S&P Emerging Market Government Bond Index. So rather than look at it, and the ratio of those standard deviations at the start of 2019, looking at an emerging market equity versus emerging market bond index, was 1.23. So equities were 1.23 times more volatile than bonds. I applied that multiple to every single default spread. So if your default spread was 3%, 3% times 1.23 gives me 3.69%. I get your additional risk premium. I add that on to the 5.96%. I get an equity risk premium for every country. Enough of the abstractions. Let me show you the picture. This is my equity risk premium by country for the world as I see it. If I misclassified a country into the wrong part of the world, just move on. Okay? I do it all the time. Now, once in a while, Belize goes off into Africa, and basically I just move things around, and sometimes it just slips through. But this is my picture of the world. So basically, let's take a region of the world. Let's take Asia. You can see the black numbers are the total equity risk premiums. That's a 5.96. First, let's start easy. If you look at Canada and the US, notice there's a 5.96% for both of them. So does Australia, Germany. What do they share in common? Remember, I started with the US premium of 5.96%. Every country that has a AAA rating, I take Moody's at their word and say these countries have no default risk, and if they have no default risk, I'm going to use the US equity risk premium. I call these mature markets, and here's my rationale for why all mature markets need to have roughly the same premium. If some mature markets have really low equity risk premiums and others have high equity risk premiums, remember this is Germany and the US. What's going to happen is money is going to flow out of the low risk. So my rationale is you can't have 5 different mature market premiums floating around. I'm going to use the US, and that might be parochial, but I do it because I trust the numbers in the S&P 500 that I need for my forward-looking premium more than any other index in the world, and I use it for all AAA-rated countries. You're saying, why are the premiums different across Asia? I've given away the answer, right? What is it going to depend on? What your sovereign rating is. Singapore, for instance, has a 5.96% premium, no country risk. Why? It's AAA rated. And as you go across Asia, you can see that different countries have different risk premiums, and they range the spectrum. You can take Latin America, which is often viewed as this hotbed of country risk, but Chile is very different. I don't want to throw Venezuela, that's too easy. No? Then even Colombia, which is next door. Basically, you can see that risk premiums vary across countries, and at least in my table, the driver of the variance is not some in-depth analysis that I did. It's based on default risk. That's its strength, and that's its weakness. Strength is it's transparent. So if you ask me where does that number come from, I'll lead you to the number. You know the weaknesses? I'm building this off default risk, and because of that, I think I underestimate risk in some parts of the world. Like what? Like the Middle East. The Middle East looks really safe from a default risk perspective. Why? Because the Saudi government has lots of cash to pay off the debt, so you get a really good rating. But when you think as an equity investor investing in Saudi Arabia, I might be missing the risk because I'm so focused on default risk. You're saying, what's that regional average that I report at the bottom? That's a regional weighted average. So if you take Asia, the way I come up with the 7.43% is I take a weighted average of the risk premiums of the countries in Asia weighted by their GDPs. Why? Because I want China to weight a lot more than Vietnam, and I said the risk premium for Asia is 7.43%. This is the most downloaded data set on my website. It gets used in the strangest places. I have absolutely no control in how it's used. I don't even know. But I hear back from people saying, I saw your risk premium there. Why did you come up with that number? And I've learned to kind of deal with some very strange requests around the risk premiums. I remember getting an email from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand until I got this email saying, we're using your equity risk premiums to set milk prices for New Zealand farmers. What? Who are you selling the milk to? Zimbabwe? No? But the usual question is, how do you come up with these risk premiums? And I have a little PDF file, basically describing what I just took you through. Once in a while, though, you will get emails from people and you have no idea how to respond. I'll give you my least favorite email of all time. April of 2009. I get an email from Lebanon. And I'm pretty excited. I don't get that many emails from the Middle East about valuation. I open up the email. Here's how it begins. You have destroyed Lebanon. I said, what? I can see myself destroying Luxembourg but after 30 years of Hezbollah and civil war, I'm the guy who destroyed Lebanon? So I said, what the heck happened here? And it turned out that the email was from a Lebanese business person who was valuing his business for sale, and the appraiser had used the risk premium from our website. The biggest plus on my website is it's free, so people just download it if they don't want to spend the money, and used it to value the company. You're saying, so what? Take a look at Lebanon. Lebanon in 2019 has a 14.99% premium, right? That number was like 16% in 2009 because you were coming off a crisis. Lebanon's rating was awful. Now imagine you're a business owner, somebody's valuing a company, they use a 16% risk premium. Lead me through what's going to happen. Your discount rate's going to shoot through the roof, your value's going to drop. He felt he'd been gypped, and it was all my fault. Now my first response was, take it up with your appraiser. You paid him, not me. But then I realized the email was from Lebanon. I should be a little cautious about how I respond. I don't want to draw a target on my back. I said, it's not my fault. Whose fault is it? How do I come up with these again? Remind me. I start with the US premium. Then I look up your ratings on Moody's. I said, it's not my fault. It's Moody's fault. And I said, if you really want to take it out on somebody, here's their address. Don't pick on me. I have nothing to do with it. There's no intellectual firepower behind these numbers. That's a minus. The plus is, I'm not making up stuff. There's no bias in there either. I'm not saying this, I like Brazil. I lower the risk premium a little bit. I didn't like Colombia the last time I went. No, I'll increase the risk premium. It's basically a reflection of where the numbers fall. You're saying, what's that box at the top? Notice there's a box at the top where I haven't put it into a region. Take a look at some of the countries there. Liberia, North Korea, Syria. These are called frontier markets, which is a nice way of saying no ratings agency is ever going to send their people in there to rate the country because they might not come out. These are essentially markets that are off the reservation. And for a long time, until 2017, I used to leave them off my list saying, hey, you know, I can't find a rating for a country. You can't expect me to come up with a risk premium. Until I get an email at the end of 2017 from a Syrian business person. There's one guy left in Syria who's actually running a business still. He says, I'm trying to estimate a hurdle rate for projects. What? Have you lost all perspective here? This is on top of your priority list, coming up with a hurdle rate for projects? You know, where are you, in a bunker somewhere looking out of the window? Eh? And he said, I'm looking on your website, there's no country risk premium for Syria. Why? A very accurate story torn. I said, you're not rated, I can't help you. He said, so what do you expect me to do? I almost said, get in a car, drive out of the country, maybe you'll have a hurdle rate next door. I have it in Lebanon, you can get there. No? But I didn't think that was the right time to bring that up. But I said, you're right, you need hurdle rates in Syria if this is on top of your priority list. So starting in 2017, I brought the frontier markets in, and here's how I did it. There's a service called Political Risk Service. It's one of many that attaches a numerical country risk score to countries, including countries like Syria. The scores go from low to high. High being really safe countries. I think Switzerland had the highest score, and low being very risky countries. I think Sudan had the lowest score. I found a country risk score for Syria. So you can probably guess what I did next. I went looking for countries with scores like Syria's score. A couple of those had ratings. I'd estimated risk premiums for those countries. Guess what I did? I took the average risk premium for the 2 or 3 countries closest to Syria in score, and I attached it to Syria. You're saying, that is so unsophisticated. Guilty as charged. If you can find a better way of estimating risk premiums for North Korea, I'd love to hear it. But now, no matter where in the world you're going, I can give you a risk premium for that part of the world. So if you go, I'll send you the link, but this is actually an Excel spreadsheet, so you can actually see all of them in much better detail than seeing it on this page. But here's why I care. I don't care about risk premiums to say, I don't do this for others, I do it for me. Because I need this to value companies, because those risk premiums become ammunition that I can use to come up with the cost of equity for a company. And I'll give you the 3 ways in which we can deal with country risk. The first is what I call the bludgeon approach. This is what most bankers and analysts seem to use. And here's what the bludgeon approach does. It takes every company in a country and gives them all the same country risk premium. So if you're an Indian company, every Indian company gets an Indian country risk premium. Every Brazilian company gets a Brazilian country risk premium. Every US company gets a US country risk premium. The second approach says, hey, you know what, so it's a constant. The second approach tries to do a little finessing, tries to bring the risk premium into the brackets and multiply by beta. So what does it do? High beta companies are more exposed to country risk than low beta companies. So the first approach, every company gets a constant. Second company, high beta companies get punished more than low beta companies. And there's a third approach that I will lay out. And for the moment, I'm going to leave it kind of abstract. Maybe your exposure to country risk can be very different from your exposure to all other risk. Right? At least let's throw that out as a possibility. And if that is the case, then maybe I should be measuring your country risk exposure separately from your exposure to all other risk. So beta measures your exposure to all other macroeconomic risk. Maybe I can come up with a lambda, looks like a beta, which looks at your country risk exposure. For the moment, you're saying, how do I come up with a lambda? What goes into it? File that away, we'll come back to it, but those are the 3 basic approaches. But in all 3, I need a country risk premium. And in all 3, you're faced with this choice of, do I attach a country risk premium based on where you're incorporated and traded, or do I attach a country risk premium to you based on where you do business? The answer to me has always been obvious, but let's see if you come up with the same answer. And if you don't, I'll change my answer to match yours. The standard approach right now is the first one. You tell me where you're incorporated, I'll give you a country risk premium based on that. The second approach requires that which one do you think makes more sense? To look at risk premiums based on where you're incorporated or where you do business? To me, it's always been where you do business. And here's why. In the late 1980s, I remember the South African mining companies delisted in Johannesburg and relisted in London. And I remember talking to the CEO of one of these companies. I said, why do you do it? You know what his answer was? Because I wanted to make country risk go away. I said, it's that easy, huh? What do you plan to do next? Pull up your mines out of the gold mines out of South Africa, put them in the middle of Yorkshire, Lancashire, wherever else you want to put them? It doesn't work that way. If it were that easy to evade country risk, we just delist locally and relist in another market. So it's never made sense to me, but 95% of valuations still do this. Some of them claim it's too much work. Hey, come on. If you have a multinational, you've got to do that work because your risk has to reflect where you do business. Which then raises an exposure question. How do you measure how a company does business? What's the only metric that you find consistently reported, not very well, but consistently reported, broken down geographically? Revenues. Right? Some companies try EBITDA, but it's revenues. So I'm going to start easy. I'm going to say, look, I'm going to focus on revenues. Why? Because I'm desperate. It's the only number you give me. And I'm going to take a weighted average based on what you report. So if you don't like the way I've broken down, for instance, Embraer, it's not my fault. That's how Embraer broke down their revenues. In 2004, Embraer got 3% of its revenues in Brazil, 97% in the rest of the world. And at least in the case of Embraer, you knew what the rest of the world was because in 2004, you know what Embraer does, right? It produces aircraft that it sells to airlines. It was selling mostly to the US and North America. So if you follow my logic then, the equity risk premium for Embraer should be 3% times the Brazilian country risk, which in 2004 was this immense number, plus 97% times a mature market risk because that's where they got the rest of their revenues. Embraer looks a lot like a developed market company. And why shouldn't it? Take a look at Boeing's revenue breakdown. It looks very much like Embraer's. And right now, what are we doing? We're giving no risk to Boeing because it's a US-based company and a huge amount of risk to Embraer because it's a Brazil-based company. If you take a company like Embev, which is another Brazilian company, it's a couple of years ago, it started as a Brazil-based company, but it's now a Latin American beverage company. And it says something about Latin America that if you leave Brazil, you actually get riskier in Latin America than if you stay in Brazil, because it shows you how much risk there is in Latin America. You see the breakdown based on revenues. The risk premium that I would use for Embev would be a weighted average based upon where they get their revenues. Okay? But now you can already see that you can't just stop doing this just with emerging market companies. If I ask you to value Coca-Cola, Coca-Cola is a US company name. It has its headquarters in Atlanta, but it gets a big chunk of its revenues in the rest of the world. In fact, you get a risk premium for Coca-Cola. This was about 3 years ago. They break themselves down into regions. You're saying, why don't they give me company numbers? Probably because they run out of pages. It'll be like 70 countries. So what they do is they consolidate regionally. Now do you see why I computed those weighted average premiums by region? Is because many companies won't break down by country, they'll break down by region, and I need the regional averages to compute. Now, as you do this, I can almost predict what some of you are going to email me. You're going to look at your company and you say, my company breaks itself down. And this is most likely, especially with doing US companies. And here's how most US companies break their revenues down. I get 71% of my revenues in the US, 29% in the rest of the world. Come on, guys. The rest of the world is a really big place. Can we start to be more specific about this? That's why these accounting disclosure laws completely, they ask for the disclosure laws cover things that I wouldn't even want to look at. Let's start by doing stuff like this. Start by breaking down geographically where your revenues are because I need it to value companies. If that's the case, it is what it is. You have to live with the data you're given, not the data you wished you were given. So if that's how it's broken down, I take the 71% I wanted to give it the US risk premium. And on my website, I also have a global average risk premium. So if I want to be really tricky, I can take the US out and compute the risk premium for the rest of the world. But I'll just take the global average attached to the rest of the world. One way or the other, I'm going to end up with a weighted average risk premium for your company. Now, in doing all of this, though, I am weighting based on revenues. And there is a danger in doing that. Where are Embraer's factories? They sell 97% outside Brazil, but their factories are all in Brazil, at least in 2004. Do you see what I'm ignoring? I'm ignoring where you produce stuff. And for some companies, the real risk might not be in where they sell, it might come in where they produce stuff. In my defense, though, most companies don't tell you where their factories are. You can guess, but because if you did, then I could figure out some way to weight the two. But in most cases, all I can say is, look, I'm using revenues. I wish I could bring in where you do production, but until you start telling me it's more. Do you know that more than half of Microsoft's software is written in Bangalore? So when I value Microsoft, should I start to bring in that country risk based on where your products are being produced? Most companies, because there's that absence of information, I stay with revenues. But there are some companies where you could argue that this is going to get you into a lot of trouble, and I'll give you an example in a minute. The second is you have to decide whether you want that whether you want to multiply that exposure by beta, which is a proxy for all your other risks. So those are the two things that are kind of at the background potential limitations. But let's talk about a business where the real risk is not in where you sell the stuff, but where you produce it. You know the business I'm going to go to, right? Take an oil company. Where do oil companies sell their oil? Into a global oil market. They don't sell even directly into countries or individuals. They sell in a global oil market. So when I look at an oil company, where's the risk coming from? It's where you extract your oil, right? In fact, the nice thing about oil companies is this they report in their annual report. This is Royal Dutch. In a 2015 valuation that I did, I wanted to come up with an equity risk premium for Royal Dutch. And I actually drew a picture. I took a picture of the world. I actually do these heat maps of country risk. You've seen heat maps? Where basically you put colors for so you put red for all the countries which have really high risk premiums. You dot the world with so a lot of red in Africa and Latin America. Russia, Eastern Europe and Russia. Then I took and Royal Dutch had a picture geographically of where their oil came from, a heat map. And guess what the heat maps look like? They look like each other. For whatever reason, God seems to put oil in the riskiest parts of the world and say, go get it. Right? And this is not just true for Royal Dutch, it's going to be true for most oil companies. The risk premium that I get for Royal Dutch of 8.26% look like an emerging market risk premium. So on the face of it, Royal Dutch is, I don't know whether a Dutch company or a British company. It seems to have dual personalities, kind of switching back and forth. It's neither. It's an emerging market company that happens to be incorporated and traded in the UK and Amsterdam. And what I'm trying to capture there is what the risk is. Any questions about this process? So basically, the equity risk premiums by country, the first step, the company risk exposure is captured. So now let me talk a little bit about this lambda concoction. Notice the word I use. Yes, go ahead.
Let's say it's an Indian company producing in India, selling in India. Do I need to even think about the country risk premium?
Is there such a company left on the world anymore? Okay, well, the question was, if I have an Indian company that produces in India, sells in India, of course you have to use the Indian equity risk premium and you're done.
Yeah, exactly.
Yeah.
I can just calculate the beta for the company.
But you still need a risk premium for India.
Yeah.
So you still need the first half. But your life got a little easier. But let's face it. You could start off with an Indian company that gets all its revenues in production in India, sells in India. March, the company could do an acquisition of remember, your companies are live lab experiments. You don't control what's going to happen. Some very strange things are going to happen to your companies. I'm not making any direct predictions, but you have 400 companies in this class. There are going to be weird stuff happening in your companies. You can't act like they don't exist. They're going to change your risk exposure. You're going to have divestitures. But if you have an Indian company, all its revenues, you have to use just the Indian equity risk. So don't go looking for trouble. If you have a domestic company, don't say, I need something where I can bring in weighted averages. This is a tool. You don't have to use it, but you might need to use it. Yes?
If it's an equivalent company which would say can be like Rwanda.
In terms of revenues or production?
In terms of production.
Right.
But has access to a capital market which is less liquid than where Royal Dutch is.
Let's make it Aramco, for instance, right? It's a Middle East. No? But but when you say it has limited access to capital, what keeps Aramco from having a second listing, right? If you have a company with this, capital limitations are often self-imposed. But even if you have capital limitations, it should not have an effect on your cost of capital. You know where it's going to show up? It's when you look at projects, even though, generally what's the rule? When you have projects that make more than your cost of capital, I said you should take them, right? And to do that, what do you need? Access to capital. So if you have a capital limitation, it's not that your cost of capital has gone up for the company. It means you're leaving projects on the table that you would have taken because you could not raise the capital, which is not great from a value creation standpoint, but could make you a target for another company that doesn't have the same capital constraints. So don't mess with the cost of capital. I've seen people try to increase the cost of capital for companies because there's a capital rationing constraint. Capital rationing is not a cost of capital issue. The problem is that you're now not able to take projects that earn more than your cost of capital. Okay. Any other questions? Yes?
So in the case of an Indian company that
Yeah.
produces India, sells India, how do you calculate the beta? Is the beta?
We'll come to that. In fact, I am not going to use a regression. I'll tell you up front that everything you've been taught about valuation, I'm probably going to not do. Because what are we taught to estimate? How are we taught to estimate beta? Run a regression of returns in the stock against returns in the market. What a horrifically bad way to think about betas. Not to mention the fact that it's going to leave us this estimation question. Do I run the regression against the Sensex or run a regression of the ADR against the S&P 500? The answer is none of the above. Regressions are bad ways of estimating betas. I have to give you an alternative. But that's one of the reasons I don't want to go down that route, is there are all these bias issues that are going to kick in as to how you think about estimating betas. As I said, that's a choice you have to make only when you have to run a regression. I'm saying I'm not running a regression. You give me an Indian steel company, I'm going to give you a way of getting a beta where you don't have to make that choice. Okay? So let's look at this third approach, this lambda approach. Any other questions I missed? Okay. I'll give you the history. In fact, I described the lambda as a concoction rather than a derivation because there was no deep thought that went into it. It was actually something I concocted on a flight to Brazil about 15 years ago. I was actually going for a valuation seminar. And the two companies I was valuing were Embraer and Embev. At that time, Embev was almost entirely a Brazilian company, and Embraer was a company you saw. And I was doing what people conventionally did. They're both Brazilian companies, give them both the same country risk premium. So I was on this flight to Brazil. It's an overnight flight. I was next to this incredibly obese person who was spilling over into my seat. I could not go to sleep. So I pulled up my presentation and I decided to kind of review it because I was going to show up. Might as well be, even though these are my own slides, I sometimes forget what's on the slides. So I get to this page where I'm estimating risk premiums, and I happen to have the annual report for Embraer with me. I pull it up. They have a pie chart. They tell me they get 3% of the revenues in Brazil and 97% in the rest of the world. That starts me thinking. I also happen to have the Boeing annual report. Don't ask me why I travel with all these annual reports. No. And I put it up, there's a pie chart. And if you set the two pie charts next to each other, you could tell which one was which. And I said, this doesn't make any sense. Embraer and Embev are both Brazilian companies, but they're very different exposures to country risk. I would expect Embev, because it gets so much more of its revenues in Brazil, to be more exposed than Embraer. That's where I started. Then I concocted a measure. I said, wouldn't it be nice if just like beta, I could come up with a measure that measured how exposed a company was to country risk, where if 1 would indicate it's as exposed as the average company, or 2 would indicate it's twice as exposed, 0.5 would indicate it's half as exposed. Why did I call it lambda? Because I've discovered that attaching a Greek letter to whatever you come up with gives this layer of sophistication that people are unwilling to penetrate. I could have called it L or just exposure, but lambda sounded better. So flight ended. I finally fell asleep because that's up to where I got. Fell asleep, woke up the next day, showed up in Sao Paulo. Do the session, and I throw this idea out to the people in the seminar. I said, wouldn't it be neat if we could measure company risk exposure with a lambda? Then one of the people in the group puts up his hand. That's a very inconvenient question. He said, how do you plan to measure lambda? I said, I don't know yet, but I have a long flight back. And in fact, I wrote one of my papers, which is on my website, on it's called Estimating Company Risk Exposure to Country Risk. But it talks about, hey, what are the things I'd go looking for to estimate lambda, and how would I come up with this lambda? So I'll give you a summarized version of that paper. Basically, what I'm trying to measure is how exposure to country risk. What do they say is the one metric you can find that's geographically broken down? It's revenues, right? So I said, let me start with a very simplistic measure of lambda. Generally speaking, the lambda then for a company that gets less of its revenues from the country should be lower than a company that gets more. So I'll use a different group of companies to illustrate this point. Tata Group, right? Large Indian family group. Embedded in the group are companies like Tata Motors, Tata Steel, Tata Chemicals, but the biggest part of the group is Tata Consulting Services, which is really a technology company. It started as an outsourcing company that gets a bulk of its revenues outside India. Mostly from the US, but also increasingly from Europe. But basically, it's a global company that has very little revenues in India. So let's assume that I took Tata Consulting Services, and this was in 2009. They get about 8% of their revenues in India. At that time, this was in 2008, 2009, Tata Motors got 91% of its revenues in India. I had to bring in one final number to come up with the lambda. I have to estimate how much a typical Indian company gets in India. And that number was about 80%. So basically I went in, I didn't do all Indian companies, but I took the 50 largest and looked up that statistic, 80%. So you see where I'm going to go next, right? If you ask me what the lambda for Tata Motors is, 91 divided by 80 is 1.14. The lambda for Tata Consulting Services is 0.09. I'm probably underestimating the lambda for Tata Consulting Services because it still does the bulk of its operations in India, right? But I'm still, based on revenues, to show you how much this measure can change, this was just before Tata acquired what's changed the company. Who did they acquire?
Jaguar.
They bought Jaguar Land Rover. Overnight, guess what happens to lambda? Their 91% became 70% because now you've acquired this global luxury maker. You're saying, this is good, my lambda went lower. But it came with a little catch. Jaguar Land Rover also has exposure to other emerging markets. So now estimate, you're saying this is a nightmare. Hey, wake up to the nightmare. This is the reality we face as companies go across countries. If you are doing lambdas, you will need a lambda for each country. And now you can see why I use the weighted average approach. Because if it's one country like it was for Embraer in 2004, you can estimate a lambda. You can base it on revenues, or you can even base it on stock prices. I actually came up with this way of estimating lambdas, which actually draws on how we estimate betas. To estimate a beta, we look at how a stock moves relative to the market, right? What am I trying to estimate here? How much is my company affected by changes in country risk, right? So I ran a regression of returns on the company's stock against returns on a country bond. Think of what? If a country goes to hell in a handbasket, its bond price is going to collapse, its returns are going to be very negative returns. So I was trying to figure out how sensitive is my company to country risk by looking at the slope of that regression. It's a very messy regression, it's tough to run, but when I ran it in 2004, here's what the numbers look like. The lambda that I got, the slope that I got for Embraer was 0.27. For every 1% country risk movement, Embraer moved only 0.27%. It was less exposed. Why? Because it gets so much of its revenues outside Brazil. In contrast, if I took a company like Embratel, which is a Brazilian phone company that gets all of its revenues in Brazil, every 1% movement in country risk will translate into a 2% movement in the company. It's much more exposed. It's kind of it's at least on the face of it, a better way of estimating lambda because stock prices reflect revenues, production, all the stuff we should worry about. But the catch is there's big standard errors, noise terms around it, but it's a way of estimating lambda. And I would do it again only if I have a single one or two countries where I have to do this. If you're like Coca-Cola in 72 countries, there is no way I'm estimating lambda for 72 countries. So I'm going to take that weighted average approach. Okay. So let's see how different the numbers are going to be, because I've presented all these different ways of estimating. I've given you my biases, but just to show you how different the numbers would be, I estimated the cost of equity for Embraer using 5 different approaches. The first one, I just took the risk-free rate, and all of them are in US dollars, because in 2004 you didn't even have a Brazilian government bond rate in reais, so I did it in dollars. So the 4% is the UST bond rate. The beta that I got for Embraer was 1.07. In a little while I'll show you where that beta comes from. I multiplied the beta in the first approach by the mature market premium, and then I added the entire Brazil. So if you think about breaking these numbers down, 3 of these numbers are very high numbers. 2 of these numbers, 17.24 and the 17.779%, are very high numbers, and they both share the same characteristic, which is I'm punishing Embraer for being a Brazilian company by giving it the entire Brazilian country risk. So if you break these approaches down, if I treat Embraer as any other Brazilian company, I end up with this really high cost of equity. Whereas if I treat Embraer based on where it gets revenues, either with a lambda approach or with a weighted average approach, or even just adding the kind of weighted average premium, I get like 11.5%. Let me pause right there. If I'm valuing Embraer, using an 18% cost of equity versus 11.5% cost of equity is going to make a big difference, right? So let's say the rest of the world is choosing to view Embraer as a Brazilian company, is using 18% as its cost of equity. And where the lone voice is in the wilderness saying, no, 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 it's really not a Brazilian company, it should be treated as a global company, and we're using 11%. What's Embraer going to look like to us? Remember, the rest of the world is pricing Embraer as a risky company. They're going to come up with a much lower value and price. We're going to find Embraer to be undervalued. This is the basis for intrinsic valuation. What are we supposed to do? Take advantage of market mistakes. Now do you see why I use the word faith when I talked about this? Because let's say you go out and buy Embraer based on this judgment you've made. For you to make money, what has to happen? The price has to adjust to value. How is that going to happen? Something in the real numbers eventually has to convince the market that they're wrong. And it'll show up. It'll often show up because in the face of the country meltdown, Embraer continues to report nice, solid earnings. But when the market wakes up and says, hey, it doesn't behave like any other Brazilian company, maybe we should adjust. It's not like they do a DCF that adjusts with a higher. It's just they wake up to the fact that not all companies in a country. I retain that faith. I believe that eventually the truth will win out because I think it's unfair to treat TCS and Tata Motors as equivalent companies. And I retain the faith that eventually markets will find out. So one of those, I mean, if you think about investment strategies that come out of this class, here's one. I make a list of the 5 companies, no, not even that, 3 companies in each market that are like Embraer. So basically I take each country and I look for 3 or 4 companies that are incorporated in that country but get a big chunk of their revenues outside. So Vietnam, that'll be Vinamilk because they sell 75% of their milk outside Vietnam. In India it might be TCS. In Brazil it might be Embraer. And I sit and wait. You know for what? For a crisis. You're saying, what if one never comes? Trust me. It's coming. I mean, the nature of emerging markets, it's not a question of whether. There's always a crisis. It could be a political crisis. It could be a, And when that crisis happens, what's going to happen? The sheep will run. The sheep are called foreign institutional investors. They basically pull the money and leave the entire, they won't even just leave the country. They leave the entire region. For some reason, they think, if Brazil is going down, the entire region must be contaminated. Let's leave. They sell everything, including the Tata Consulting Services, the Embraers, wait for that time, buy then, and then sit and have faith. How long will you have to wait? I have no idea. But if you look at my portfolio, probably 7 stocks I've bought over the last 15 years on this, where a crisis happened, I go and buy the stock, and I wait essentially for that time of adjustment to come. So don't be crazy and do this. Don't take all your money now and buy the 9 stocks in the world that are, it's not the way the world works. You've got to get these stocks at a decent price. And I'm going to argue that that's going to happen in the midst of a crisis. Any questions about country risk and exposure to country risk? Now let me give you my alternative. Yes, go ahead. No. Market risk premiums are not, what is it used for, you say?
I guess what I'm saying is typically if you're looking at a foreign company listed in the US,
Yeah.
you're probably comparing that foreign company to other US.
That's pricing. That's not valuation. So we'll talk about pricing. If you want to do pricing, you can say, look, and I'm not even sure that's sensible pricing, to be quite honest, right? Because then all those emerging market telecom companies are going to look cheap, even in the US market relative to their developed market counterparts. But if you're doing valuation, it's not about what I'm comparing it to, because it's all about valuing the company based on its fundamentals, right? But you're right, in pricing, that's what people do, and that's what gives us this opportunity, because they use this broad brush. You're saying, you know what, you shouldn't be using that broad brush to price all these companies at the same level. You should be thinking of them very differently, because they're in the same sector, they trade in the same market, but they're very different companies. So let me give you my implied equity risk premium pitch. Basically, the historic risk premium is backward looking. I want something that is forward-looking. And I'm going to do what I did with the start of the class. I'm going to look at what you pay rather than what you say. You know what I mean by what you say? If I came and asked you, what's a good equity, what's a fair equity risk premium? You can make up any number, 50%, 8%, 3,000%. I mean, there's nothing that constrains you. And that's what happens when you do surveys. You ask people, what's a good risk premium? What you pay, though, you're putting real money behind. So then I can say, okay, if I know what you pay, then I can back out what your premium is. Of course, it's a little messier when I have an index and I have to estimate the cash flows, but think of it as an expansion of that very simple example we started the class with. So let me take you back to January 1st, 2008. Why so far back in time? Because let's start with the year of the crisis. At the start of the year, I could tell a crisis was coming. Absolutely not. I had absolutely no idea. I admitted up front. I admitted after the fact. I really had no idea the crisis was coming. January 1st, 2008, like I had for the start of every year for the previous 18 years, I decided to compute an equity risk premium for the US market. I started with the S&P 500 on that day. It was 1,468.36. So that's what you're paying for stocks. And then my next step was estimating the expected cash flows on stocks. And to do that, I took what the cash flows. And remember, when you talk about investing in stocks, you're looking at two kinds of cash flows, dividends and stock buybacks. They're both cash flows to you. Think of yourself as owning all of the equity. That number jumps around. So I took a smoothed out value for the previous 7 years of about 4%. In fact, it's pure coincidence that the cash flow over the previous was 4.02 and the risk-free rate was 4.02. Don't view that as kind of some rule that you can follow from this point on. It worked out. And I projected out, assuming those cash flows would continue for the next 5 years. You're saying, why didn't you see the end of 2008 coming and the cash flows collapsing? As I said, I didn't see it. So I took those cash flows and January 1st, 2008, in real time, I projected the cash flows out. And of course, I couldn't keep doing this forever. In fact, to give you the analogy of what I'm trying to do, do you know how to compute the yield to, I know you do, but I'll ask you anyway. Do you know how to compute the yield to maturity on a bond? How do you what's the process of computing yield to maturity? Hate to put you on the spot, but what do I start with? I start with the price of the bond. Good, okay, let's keep going.
The duration.
No, let's not bring duration yet. That's too quasi-sophisticated. You take the coupons, you take the face value, and the yield to maturity is that discount rate that makes the present value of the cash flows of the bond equal to the price. It's an internal rate of return for a bond. I'm doing exactly the same thing with stocks, right? Instead of a bond price, I'm using the S&P 500. Instead of coupons, I get the expected cash flows in the next 5 years, and I have one little loose end. Unlike a bond which has a finite maturities, what's the maturity for stocks? They go on and on and on. So, and I can't keep projecting cash flows forever. So after the 5th year, I assume the cash flows will continue to grow at the risk-free rate. Now this is something you're going to see me do, and you've probably seen it if you looked at the two valuations. When I get to steady state and I want a growth rate forever, I'm going to set it equal to the risk-free rate, because embedded in the risk-free rate is an expected inflation and an expected real interest rate, right? We talked about this. And embedded in a growth rate of the economy is an expected inflation rate and expected real growth rate. It's a best projection estimate I can get for growth rate and cash flows beyond year 5. So let's see what we have. I know what you paid, 1468.36. Those are the cash flows for the next 5 years. I'm discounting them back today, internal rate of return. And beyond the 5th year, what am I assuming? Cash flows will grow at a constant rate forever. The only number I don't have is the R, the discount rate. I know the cash flows. I know the level of the index. I know it's a little messier than computing the YTM button in your calculator. It requires that you use either the solver function or the goal-seek function in Excel, because the discount rate changes, all the numbers will change. And I solved for that discount rate. At the start of 2008, that number was 8.39%. You're saying, what does it even mean? At the start of 2008, if you bought US stocks, I don't care what you hoped you would make, what you prayed you would make, what you thought you would make, given what you paid for those stocks, you could expect to make a premium. An expected return of 8.39%. Watch what I paid, not what I said. The risk-free rate, the T-bond rate was 4.02% on that day. What's the risk premium? It's what you earn over and above the risk-free rate. So that difference was 4.37% at the start of 2008. You're saying how I used it? All the stocks I valued in January 2008 in the US, I used a 4.37% premium. Basically, that becomes my mature market premium. Until 2008, I used to do this once every year. And when people push me on, and I said, my response would be, this is a developed market. The price of risk doesn't change very much on a year-to-year basis. So all I have to do is once every year. I think the gods are just waiting for you to say stuff like this so they can dump on you. Because we discovered in 2008 how much even in developed markets the price of risk can change. Okay? Because when you get to January 2009 and you recompute the risk premium for the S&P 500, remember it's only 12 months later, here's what the numbers look like. First, do you remember what the index was at the start of 2008? And you can look at the previous page if you want. It's 1,468.36. Look at what happened in that 1 year. The level of the index has dropped almost 40%. It's now down to 903.25. I'm being a realist. We're in a recession now. We're in a crisis. The cash flows have also dropped if you compare it to the previous page. But they haven't dropped as much as the index has. The bottom line is if you look at the end of 2008, the start of 2009, that expected return of 8.39% has now gone to 8.64%. You're saying big deal, move 25. But look at what happened to the risk-free rate. Because in a crisis, what happens? People flee to safety. The risk-free rate had dropped to 2.21%, and my equity risk premium, which used to be 4.37% at the start of 2008, has jumped to 6.43% in 1 year. Yeah.
Please explain the last term.
Basically, that's a cash flow growing every year forever. It's just the cash flow in the following year, in year 6. That's the numerator. So that's cash flow in year 6, right?
Why is it growing? Why is the risk-free rate?
Because, as I said, the risk-free rate is embedded in it expected inflation and expected real interest rates. And the nominal growth rate of the economy, if you think about what goes into it, remember that graph we saw in the T-bond rate, that intrinsic risk-free rate? Expected inflation plus expected real growth is very closely a proxy for expected inflation and the real interest rate. So I'm drawing on the history in the US, which is the T-bond rate has been an extraordinarily good predictor of nominal growth in the economy. And ultimately, if you're looking at all stocks, your earnings have to grow at the same rate as the economy, and the risk-free rate becomes that proxy. Right?
Okay, so instead of assuming a perpetuity...
I am assuming, but you still have to grow.
Yeah, but instead of 4%, you're assuming...
You can't assume 4%. If the risk-free rate is 2.21%. Say, because then what's going to happen is the economy is growing at 2.2% and earnings continue to grow at 4%, your economy is going to blow up. You're going to end up with 100% margins. So once you get to steady state, you can't do any of the projections for the first 5 years. You've got to revisit them to make them consistent with what you think about the economy. So in 1 year, the equity risk premium in the US jumped by more than 2%. That is the biggest single 1 year change. And almost all of that change happened when? Between September 12th of 2008, which I call my last day of innocence, and December 31st of 2008. And I call it my last day of innocence because I really believed on September 12th of 2008 that the world was divided into developed markets and emerging markets, and never the twain shall meet. In developed markets, you had central bankers who made decisions when the best interest of the economy. Price of risk did not change. In emerging markets, that was not true. Of course, I've learned in hindsight that there are lots of shades of gray now. But on September 12th of 2008, I really believe that. September 12th of 2008 was a Friday. I remember it distinctly. I was going home at 3:30. Why? Because I go home whenever I feel like going home. And I just wanted to go home early that day. I think one of my kids had a baseball game or something. I was listening to the news on my way home. And there's a story that had passed the news wires that Lehman was in trouble and that Barclays was negotiating to buy Lehman. And the talks were shaky. If you asked me, did you start worrying about it? I said, this is a classic company-specific problem. By Monday, either it's going to happen or not happen. If it doesn't happen, Lehman's going to collapse, and who cares? And I got home, and I spent the last quiet weekend of the year. Because starting on Monday, it's like hell had imploded. The market went into crisis. And every day I would torture myself by computing the implied equity risk premium for that day. You can say, how much can it change in a day? Those of you who never lived through that quarter some of you, the last quarter of last year started to get a flavor of what it feels like to see the market jump 500 points. Because you'd have the market up 2,000 points by midday and be down 1,000 points by the end of the day. So every day I compute the risk premium. See this green line? That is actually my day-to-day estimate of the implied equity risk premium. You start the line at about 4.3%, very close. So in September 12th of 2008, I felt pretty good about my January 1st estimate. I was still pretty close to that. But you can see the number climbing. And what's causing it to climb? If stock prices collapse, the price of risk just went up. What happens in crises is you're repricing risk. Because crises are not caused by cash flows imploding overnight. They don't do that. But you can change your mind about what the price of risk is. So last year, for instance, I do this now consistently. Every time there's a crisis, this is my defense mechanism. Against what? Against all the talking heads telling you all these crazy things. Because they tell you they're all over the place. I said, look, rather than listen to some guy who absolutely has no idea what's going to happen, prognosticate about the future, I'm going to go back to basics and compute what happened yesterday. So I did this in October of last year. I did in February of last year during the tech company. But it's a way in which I try to get a sense of what's going on in markets, and it allows me to come up with that implied premium. So let's give you the updated number. January 1st, 2019. Here's what my implied premium looked like. So this was just a couple of months ago. So S&P 500 was at 2,506.85. My cash flows, again, are composed of dividends and buyback. Notice how much of my cash flows last year in the US came from buybacks. So if you look at the top, in the trailing 12 months, dividends were 52.25. Everything is stated in S&P 500 units. But basically, if you think about billions of dollars, dividends were about $660 billion. They comprised almost 65% of all cash return. So that's why I have to count buybacks. I've made my best estimates of the projections. I did cheat and use analyst projections of growth not because I think they're right, but because I'm trying to back out a market expectation. So if that's what the market's expecting about growth, that's what I should be using. At the end of the 5 years, I do exactly what I've done every year for the last 27. I use the risk-free rate as my growth rate forever. And at the start of 2019, the expected return on stocks was 8.64%. Same process, same internal rate of return. T-bond rate was 2.68%. The difference between the two is 5.96%. And if that number looks even mildly familiar, that's what I've been using as my mature market premium. That's where my mature market premium comes from. But I couldn't rest too long on this number. Because what's happened in the last 2 months? Good stuff or bad stuff? Let's start with the direction. At least for stocks, it's been good stuff. The S&P. So that premium at the start of February was down to about 5.5%. It's 5.56%, which is what I use for my Apple and Amazon valuation because I did them in February. What will it be at the start of March? I have no idea, but I will find out. And in March, when I value companies, I'll be using the March premium. So now this is my way of making sure that the price of risk I'm building into my company valuations reflect what markets are demanding out there rather than some wish-for number. So my guess is, given what stocks have done so far in February, I wouldn't be surprised the premium by the start of March is down to 5.46%, 5.4%. Okay? It's dangerous to make statements. Who knows? Market could be down 2,000 points tomorrow. But given what it's done. So this is why it's forward-looking and dynamic, because it reflects what's happening in the market. So if you want to get a sense of what this number has done since 1960, trust me, I haven't been doing it at the start of every year since 1960. That would required me to be some kind of a prodigy, and I was not. But I went back in time and I acted like I had no information. Basically, I had to put myself in it's very difficult to do. You have to put yourself in a time seal. Basically, it's if on January 1st, 1960, based on what I knew then. So I've tried my best to keep the 2020 hindsight out of it. That's what this is actually the story of U.S. stocks since 1960. 1960s, incredibly stable period for U.S. stocks. The price of equity risk was between 3 and 3.5%. Notice in the 70s something is happening. The premium is rising. First question, when premiums are rising, what's happening to stock prices? They're going down. The same relationship as between interest rates and bond prices. What's causing that? Why did risk premiums climb in the 70s? High interest rates are always output variables. What drives high interest rates? We've talked high inflation. And then you go back, it's oil price shock, et cetera, feeding through. Inflation is deadly for stocks. It pushes up risk premiums. 1978, you know what the Dow was at? 771. 3 numbers. Scary thought, right? In fact, Business Week ran an entire issue saying stocks are dead. And what should you learn from this? Whenever financial news magazines start running headlines like that, go into stocks full bore. Because if you look at stocks, 1978 was the start of one of the great bull markets of all time. Look at what's happening in the equity risk premium for the next 20 years. They fall and they fall and they fall. They keep falling. In fact, by the end of 99, the implied equity risk premium in the US was down to 2%. Think about it. What am I offering you? 2% more than the risk-free rate for investing in stocks? What's your reaction? That's too low. If your reaction is that risk premium is too low, what are you telling me about stock prices? It's too high. Any statement about the overall market is actually a statement about equity risk premiums. So ask me the question. Is the market in a bubble? You know how often I get asked that question? Is the market in a bubble? And to answer that question, I go back and look at the equity risk premiums. Because the market is in a bubble, what should I see? A really low equity risk premium. If you're demanding a 2% premium, way below what I've settled for historically, hey, maybe I'll join your bandwagon and go around saying, the market's dying, the market's dying, the market's dying, let's get out, let's get out, let's get out. There are bubblers out there, right? Some of them have Nobel Prizes, but that doesn't make them any less bubbly about their predictions. It's a bubble, it's a bubble. And my reaction is, you can tell me all the stories you want about it being a bubble, but the numbers don't back it up. Why? What's the premium right now? 5.96%, which is actually higher than the premium has been for the last 10 years, the last 20 years, and the last 50 years. So if you're going to tell me a bubble story, it better have different legs than, hey, I just think stocks are too high. So to me, this number becomes a metric I use to decide, hey, do you think markets are in a bubble? This is really the number we should be focusing on. A couple of final links on the equity risk premium. One of the things about these equity risk premiums is I'm going to take them around the world and attach them to risk-free rates. And these risk premiums are estimated using US stocks and US risk. So let's say you're in a market with 7% risk-free rates. Question is, can I attach this 5.96, even if it's a mature market, and that's always been a question that I've wrestled with. So one of the things I did was I looked at the equity risk premium in the US, going back to 1960, as a function of the T-bond rate. The question I was trying to ask is, when T-bond rates are high, is the risk premium higher? Because then maybe I should be adjusting risk premiums for the level of the risk-free rate. This is actually a weekly challenge for this week. Is I'm going to give you the equity risk premiums every year from 1960 and the T-bond rates every year. And I want you to statistically work out the numbers. But even without statistically working out the numbers, what do you see in that graph? Except for the 1970s, where you see this link between T-bond rates and risk premiums, the rest of the period, there seems to be very little relationship between how low or high the T-bond rate is. So here's my conclusion. As long as you don't have really high inflation, your T-bond rates shoot up to double-digit levels. Equity risk premiums can be safely transported to other risks. So if you gave me the risk premium for the US and you gave me a euro risk-free rate, I have no qualms about using the US risk premium on a euro risk-free rate, saying, hey, it's close enough, I'm going to get away with it. Right? We'll talk about what to do if you don't buy into that, but there seems to be a little link. I'm going to show a second graph, and I'm sorry, this graph is much messier than I wanted it to be. There are 2 series in this graph I want you to focus on. The first is the blue line, which is the implied equity risk premium by year. So that's the price of risk in the equity market. The black line is actually the default spread on a BAA rated corporate bond. So this is actually from the Federal Reserve's data side. They keep this index. Now, so that's the price of risk in the bond market, right? So I have a price of risk in the equity market, price of risk in the bond market. Most of the time the two move together. Why? Because if one group panics, the other group tends to panic as well, often because it's the same group. But there have been 2 periods in the last 20 years where the two have moved in different directions. And they both have been precipitators for corrections. The first is in the late 90s. Take a look at what happened in the late 90s. You see the equity risk premium dropping, the dot-com boom, and the default spread actually increasing during that period. So basically the price of risk in the bond market is rising, the price of risk in the stock market is dropping. In fact, by the time you get to 1999, the equity risk premium is down to 2%, and you're charging a default spread, and a BAA rated bond is a solid investment grade bond of 2%. So as an investor, if you were rational and basing your asset allocation decisions based on the trade-off you're getting, at the end of 99, what should you have been doing? Investing in bonds and avoiding stocks, saying, I'm not getting it. None of us did that, but in hindsight, that's what we should have done. And if you're a CFO of a company and you're thinking about raising capital, this is not a corporate finance class, but if you're raising equity and debt, and you see the price of risk in the equity market is abysmal, low by historical standards, down to 2%, and the bond market actually is charging spreads roughly what it did before, how are you going to raise money, equity or debt? Late 90s was a golden period for raising equities. Telecom companies raising stocks, essentially because of price of risk. There are consequences to these numbers, both from a corporate side and the investor side. Let's move forward 3 years. 9/11 happens, and Alan Greenspan announces that he is not going to allow the US economy to go into a recession. The hubris of central bankers. But in what's called the Greenspan put, he kind of delivered, right? By doing what? By essentially pumping up the bond market. If you look at the default spread, starting in about 2002, you can see default spreads collapsing. 2002 through 2006, default spreads are decreasing. Same bond, BAA rated, equity risk premiums are staying up. So think through the consequences. In 2006, you look at those two markets, you're getting a disconnect. So in 2006, if you're a CFO raising money, guess what you're doing? This is the golden age of leverage buyouts. You borrow money because the debt market is not charging you enough of a spread, and you buy back your own stock. Every time you have a disconnect, though, there is a day of reckoning. For me, the 2008 crisis was the first one that was created by most crises are created by the equity guys because they get crazy, they get over-exuberant, irrationally exuberant, whatever you want to call them. But the 2008 crisis, people call it a subprime crisis. There's nothing wrong with lending money to subprime borrowers as long as you do what? Charge a high enough interest rate. There's nothing wrong with lending money on housing as long as you build in default risk. The problem with what people were doing pre-2008 was not that they were lending money to people who should not have been borrowing money. They were lending money to people who should not have been borrowing money and charging them rates as if they would never default. Of course, that blew up. And you saw the convergence again in 2008. So one of the things I've taken to doing over the last, since the crisis, is I now track both numbers because I do the implied premium for the equity market. The BAA spread is actually a public number. You can go look it up in the Federal Reserve. And if the numbers start moving in different directions, I have to start worrying. Okay? In 2018, for instance, you saw the BAA default spread decrease and the equity risk premium rise. But it's just 1 year. If this happened 2 years, 3 years, now I have to start thinking about it. One final graph and we will end for the day. This graph I have the implied equity risk premium, the blue bar, blue column. I have the BAA default spread in that brown column, which is what you saw on the previous page. And I've now added a third risk premium. Are any of you work in real estate? Okay. What's a cap rate in real estate? No? Somebody working in real estate, can you tell me what a cap rate is? Yes? It's a multiplier you apply to get to a terminal value, right? So if you have a building, you have income of $1 million, the cap rate is what you use to come up with the price of the building. So if you have a cap rate of 10% with $1 million income, the value you attach to the property is $1 million. I'm sorry, $10 million. So basically the cap rate. So the cap rate in a sense is an expected return that real estate investors attach to real estate. I have the cap rate going back in time to 1980. I have the risk-free rate every year. I computed an implied, a real estate risk premium. So now I have three markets on this graph. I have the equity market price captured in the equity risk premium, the bond market price of risk captured in the default spread, and I have a real estate risk premium captured in this last line, which is the first notice in the 1980s what's true about that number. What do you notice about the real estate risk premium? It's negative. You're saying that makes no sense. It actually made complete sense. Because when I was doing my MBA, you know what the conventional advice was? If you own a lot of financial assets, buy a house. or invest in real estate. The rationale being, real estate as an asset class does not move like financial assets, so buying it, you actually make your portfolio more diversified. It's going to counter risk. It's like a negative beta investment. And in fact, what you get as an expected return on a negative beta investment is you might have to settle for a negative risk premium because it's a risk reducer. Notice though what's starting to happen in the 90s? The real estate risk premium is starting to behave a lot more like the equity risk premium, the bond market premium. What caused that? One is securitization, which was, as you securitize real estate, this seems to be true for any asset class, you start to see it behave more like other financial assets. And it has incredible consequences for most of us. Because in the old days, when your stock portfolio collapsed, at least you could look at a house and say, I'm glad I own the house, it's held up its value. In the last decade, what have you noticed? Years that are bad for stocks also tend to be years that are bad for real estate. Which means if your old way of diversification was to hold real estate, it's no longer working. Okay? I don't know whether this has made its way into those manuals that wealth managers use because it has to. The world has shifted under us. Diversification has become a lot more difficult, and you can see that captured in the risk premiums. So let's stop there. When we start off next session, we're going to talk about betas. Yes.
One quick question. So, when you estimated that 4.02% number for which is dividends plus buyback, I was thinking that inherent in that assumption is that most companies have a similar policy of right. But if you believe that the market moves in relative PE terms, then doesn't it give you the right? So you can have use the dividend too. Some people actually use inverse dividend as a proxy. In a mature market, no buyback. Yeah, the dividend yield becomes a proxy. The earnings yield is never a proxy. Yeah, yeah, because unless you but if you track on the price ratio against the price, yeah, like market returns on companies do buybacks when debt markets are conducive. It's not easy to buy backs because of the cash flow. The convention, it's actually more the rule than the exception. Now it's buybacks. So buybacks is just flexibility. Yeah, it's got nothing to do with timing again. And there's no assumptions about when they buy back. I'm just saying, if I were the investor owning the entire S&P 500, and I look at count my cash flows every year, the amount paid out as dividends is my cash flow. The amount paid out as dividends also is my cash flow because I own